Welcome to the deep dive. Today, we're really getting into the Q1 FY26 results for ITC Ltd. This covers the quarter ending June 30th, 2025.
That's right.
We've gone through their media statements, financial filings, even the specific announcements on restructuring, all dropped on August 1st.
A lot of material to sift through.
Exactly. And our goal here is simple. Cut through it all, give you the crucial insights, the shortcuts to understanding how this major Indian company is doing. We'll even pull out some surprising bits and context you might miss otherwise.
And it's important right off the bat to remember the context. These aren't just numbers. They reflect how ITC navigated a pretty dynamic economic scene, both globally and here in India.
Yeah, that context is fascinating. The Indian economy itself, it showed, well, resilience. That's the word they used. Despite all the global static geopolitics, trade issues, uncertainty, India held up.
Which is quite something, given those global headwinds they mentioned.
Definitely. But it wasn't, a completely rosy picture. The indicators were mixed. Positives. Agriculture, services did well. Inflation cooled a bit. Rural wages saw some growth.
Oh, some good signs there.
But then areas like industrial growth, car sales, credit, even power consumption, they were more subdued.
A real mixed bag then.
Totally. But encouragingly, rural demand stayed strong, and we're seeing maybe early signs of urban consumption picking up again. Plus, hopes for a good monsoon and crop sowing look positive for the rural side going forward.
Precisely. And that whole economic backdrop is, well, it's the stage for ITC's results. Their performance looks even more significant when you see the varied, almost contradictory environment they managed it in.
So how did ITC actually do? Let's hit those headline numbers for Q1. Standalone gross revenue up a solid 20% year-on-year.
Wow, 20%.
Yeah, driven by cigarettes, Agri Business, and FMCG, though that's excluding notebooks, we should note.
Right.
EBITDA, their operating profit measure, was up 3% year-on-year. But interestingly, if you take out the struggling paper segment, that profit growth looks healthier, at 5%.
Okay, so paper was a drag there.
Seems like it. Now, consolidated results, that's including subsidiaries, also saw gross revenue up 20%, and PAT, profit after tax, was up 5%, the total consolidated revenue. A huge Rs, 20,911 crores.
That 20% top-line growth, as you said, is really strong. It suggests they're gaining ground, leveraging their reach and innovation. But the profit growth being more moderate, 3-5%, that points towards those cost pressures, probably higher input costs we need to dig into. It shows the diversification helps, but they're definitely managing those cost challenges actively.
Okay, let's unpack the segments then, starting with the traditional core, cigarettes. Net segment revenue up 7.7% year-on-year. Segment PBIT, that's profit before interest and tax, up 3.7%.
Steady performance there.
Yeah, and the drivers seem to be their premium offerings doing well, plus strategic moves in competitive areas, and importantly, efforts to counter that illicit trade problem.
Yeah, and on the margin side, they mentioned using up some high-cost leaf tobacco inventory, which weighed things down a bit. But they balanced that partly with a better product mix, focusing on premium and cost management. Good news is tobacco prices seem to be moderating in the current cycle, which should help. And connecting this to the bigger picture, tax stability helps the legal industry fight illicit trade. Plus, that new track and trace provision in the GST Act, that's a big deal, expected to help curb illegal cigarettes and boost government revenue too.
Okay, good context. Now let's pivot to where many of us interact with ITC daily, the FMCG Others segment. Lots of brands here.
Yes, the everyday stuff.
Revenue growth picked up here. If you exclude notebooks, it was up 8.6% year-on-year. Overall growth was 5.2%.
So notebooks still facing headwinds.
Definitely. The report mentions deflationary pressures from cheap paper imports and local players making opportunistic moves. Also, those unseasonal rains hit beverage sales, apparently.
Ah, right, weather impact.
But despite that, what drove the growth? Staples, biscuits, dairy, premium personal wash, home care, agrobotics, they all did well. And their premium ranges and those new-gen channels, e-commerce, quick commerce, modern trade, they're still growing fast.
That digital push seems key.
It does. And that digital-first and organic portfolio, think Yoga Bar, Mother Sparsh, Prosuma 24 Mantra, is apparently clocking around Rs 1,000 crore in annual revenue run right now.
That's quite the scale-up for newer brands.
It is. Now, margins in this segment.
Right, the EBITDA margin. It was up slightly from the previous quarter, about 50 basis points, but compared to last year, it's down. Segment EBITDA was 9.4% versus 11.3% a year ago. Why? Well, commodity prices are still elevated year on year. Think edible oil, wheat, cocoa, soap inputs.
So cost pressures again.
Exactly. But they're fighting it with cost management, pushing premium products, and careful price adjustments.
And some specific brand callouts were interesting. Ashervad Atta strengthening its lead. Sunfeast Biscuits doing well. New launches like Mom's Magic Shines. Oh, and that Shah Rukh Khan campaign for Dark Fantasy.
I saw that one.
Over 200 million views, apparently. Huge engagement.
Wow.
Also, Yippee, Korean noodles scaling up. Bingo launched a mystery pickle flavor.
Mystery pickle. Interesting.
Right. And growth in Sunrise Spices, ITC MasterChef Frozen Foods, Ashravat Svasti Dairy. Lots happening.
Definitely a busy quarter for FMCG launches and marketing.
Now, Agri Business. This was, well, pretty explosive. Revenue up 39% year on year.
Yeah, that's a huge jump.
And segment PBIT up 22%. What fueled that?
It's a combination of things. Seizing opportunities in agri-commodity trading, for one, and strong leaf tobacco exports.
Yeah.
With all the global uncertainty around food security and inflation.
Right, the geopolitical stuff.
Exactly.
Yeah.
ITC sourcing network, their digital tools, their expertise, it really allowed them to capitalize. India even put stock limits back on wheat in June, showing how volatile things are. But ITC's leaf tobacco exports grew strongly, thanks to their quality and relationships. Plus, they're scaling up exports of nicotine products, too. And that ITC MAR's platform you mentioned earlier.
The digital one.
Yeah. It's now sourcing directly from farmer-producer organizations for about 40% of the wheat needed for Ashravat and the agribusiness itself. That drives efficiency and quality. It's quite strategic.
Very impressive. Okay, so while Agri soared, let's look at paperboards, paper, and packaging. Bit of a different story here, wasn't it?
Yes, definitely more challenged.
Segment revenue was up 7% year on year, mostly due to higher volumes. But the profit, segment PBIT, was down sharply, 37.8%.
Ouch.
What hit them so hard?
It was a perfect storm, really. A flood of cheap imports hitting global markets, including India, which hurts prices, plus high domestic wood costs a key input, and just generally soft prices for their end products.
Squeezed from both ends, then.
Pretty much. On the upside, their specialty papers, especially decor paper, grew well after they expanded capacity. And they're making moves, boosting their own plantations, refining the product mix, focusing hard on costs. They're also talking to policymakers about, measures to protect the domestic industry. And importantly, their sustainable packaging portfolio has grown massively, like over 3 times in 4 years. So they're clearly investing in that future trend.
Good point. Okay, let's shift gears to strategic growth areas. The ITC Next strategy mentions a food tech business. Tell us about that.
Yeah, this is interesting. It's about leveraging all of ITC's existing strengths: food science, manufacturing, their big food brands, culinary skills.
And applying it to online food delivery, basically.
Exactly. Cloud kitchens. They've scaled up fast, about 60 kitchens in 5 cities now.
And the GMV, the sales value, crossed Rs 100 crore last financial year.
Which is significant growth.
They have 4 brands: MasterChef Creations, Ashravat Soul Creations, Sunfeast Baked Creations, and Sancho by ITC MasterChef.
The key here is capital efficient. They can expand into this booming online food market without building lots of physical restaurants. It's a smart way to tap into that convenience trend and diversify, a big part of their future plan.
Makes sense. What about other strategic moves? Acquisitions, restructuring?
Right, there are a couple of notable ones. They upped their stake in Mother Sparsh Baby Care to nearly 40%. And they fully acquired Stressed Natural Bioproducts. That's the 24 Mantra organic brand, making it a wholly owned subsidiary back in June.
Okay, so bringing organic fully in-house.
Precisely. And following that, the board approved a plan to merge both Tresta and another wholly owned subsidiary, Wimco Ltd, into the main ITC company.
So, simplifying the structure, what's the logic behind merging them in?
It's mainly about synergy and efficiency. By bringing them fully into ITC, they can better integrate things like product development, sourcing, manufacturing, distribution, unlock value, basically. It also means more efficient use of capital, better cash management, and creates a stronger base for growing that organic foods business.
And no new shares needed, right? Since they already own them.
Exactly. It's an internal cleanup, essentially. No change to ITC's overall shareholding pattern, just makes operations smoother.
Got it. And briefly, the hotels business, that was a big move, the demerger.
Yes, that became effective January 1st this year. It's about focus. ITC can concentrate more on FMCG, Agri, Paperboards, and the hotels business, as a separate group company, can pursue its own growth strategy, maybe attract different investors.
Unlocking value for both sides.
That's the idea. And it's worth noting, the results did mention strong performance from group companies, including ITC Hotels Limited. So the demerged entity seems to be doing well.
Okay. Now, let's talk about something ITC is really known for, maybe their unseen pillar, sustainability.
Ah, yes, the triple bottom line performance. They
Yeah.
really are a standout here.
The stats are just incredible, and they've been doing it for so long. Water positive for 23 years.
Longer than many companies have even thought
You're
about.
carbon positive for 20 years. Solid waste recycling positive for 18 years. It's foundational for them.
Absolutely. And the external validation is there too. That AA rating from MSCI ESG for the 7th year running, highest among global tobacco firms.
Impressive. Inclusion
Inclusion in the Dow Jones Sustainability Index for 5 years. Top A ratings from CDP for water and climate stewardship.
They walk the talk.
They do. 9 units have platinum certification for water stewardship. Over half their energy, 52%, from renewables. And they maintained plastic neutrality last year, managing about 76,000 tons of plastic waste.
So connecting this to the bigger picture, what does all this ESG leadership mean?
It means resilience. It means brand value. It builds what they call responsible competitiveness. In today's world, these sustained achievements aren't just nice-to-haves. They're becoming fundamental to long-term value creation and risk management.
Okay, so we've covered a lot. For you, the listener, what are the main things to take away from this ITC deep dive?
I think the first thing is that resilience. Despite challenges, that 20% gross revenue growth is strong. It shows their diversified model is working, even with those input cost pressures.
Yeah, the diversification really stands out. Strength in agri and cigarettes provides a base. Then you have the momentum in FMCG, even with category-specific issues, and these new growth engines like food tech.
They're not reliant on just one thing.
And those strategic moves, the acquisitions, the amalgamation plan, show they're actively shaping their future portfolio, especially in growth areas like organics.
It's proactive, not reactive.
Plus, that whole ITC Next strategy framework focusing on tech, consumers, climate, inclusion gives a clear sense of direction.
And underpinning it all, as we just discussed, are those world-class ESG credentials. That's a unique advantage. It builds enduring value that goes beyond just the quarterly numbers. It's about long-term sustainability in every sense.
So complex picture, but hopefully clearer now. What really stood out to you as you listened?
And maybe something to think about after this. Given ITC's decades of being water, carbon, and waste positive, how might that kind of deep-rooted sustainability actually drive financial resilience and even innovation, especially when facing economic uncertainty and climate challenges? Worth pondering.
Definitely food for thought. We hope these insights help you in your own understanding and further exploration of ITC.